It's so nice to see so many faces out there. Thank you for that. This is our first, kind of digital education session that we've done. And so we're so glad that you can join us. Since we do have a pretty good crowd, if you could put yourself on mute, that would be great. For most of us, it's the little microphone on the bottom left-hand corner that you can hit mute, and then there'll be a chance later on to unmute. Thanks, that is great. We're really excited to share about our kind of journey with digital assets and cryptocurrency. It has been an interesting one, and I've gotten to experience it firsthand since joining the firm about 1.5 years ago. And some of us, me included, came from a kind of a place of skepticism, but as with many new things, we wanted to really learn about this newer technology. And when you hear things on the news, you're like, you want to know what are they really talking about? So we went down a journey into learning about this. Jamie is going to lead us through most of our discussion today. And Jamie, you want to talk a little bit about our firm's journey?
Absolutely. I mean, I can tell you, I was very skeptical at first. I've been getting questions on Bitcoin from clients for years, and my stance was always kind of in line with what I'd call the financial establishment, which was that blockchain technology is very disruptive. It's real. It's going to change the way we do things, but it's also very early. There are thousands of cryptocurrencies out there. I don't know if in 10 years Bitcoin is going to be the winner, or Ethereum or Polkadot or Cardano or thousands of other ones. And I sort of looked at it as like choosing VHS versus Betamax, is that you could be too early and pick the wrong horse. And even though the technology is around, you could still be wrong. And that's what I would tell people. I'd say, I don't want to invest a significant amount of your capital trying to choose VHS over Betamax. And something happened that really kind of led us down this path. And that's that I had a client who had a very, very large position in Bitcoin. And he started with a not so large position, and it grew, a significant amount. And we were having a meeting, and I was sharing with him my concerns around inflation. He agreed. Inflation, we'll talk about it more, but that's been a big concern of ours for the last 2+ years. And I said, like any good financial advisor, I suggested that he rebalance. I said, regardless of how you feel about Bitcoin, this has gone up a lot. Just like any other asset, you should probably sell some of it, take those gains off the table and reposition it into something else in your portfolio that's gone down. And he thought about it and he said, I really agree with you, but I'm going to hold on to my entire Bitcoin position as an inflation hedge. And at that point, I kind of scratched my head and I said, I feel like I need to learn more about this because it's coming up more and more. I'm not convinced that I gave this client good advice. And so I started learning everything I could, first about Bitcoin, then Ethereum, then about decentralized finance and the broader cryptocurrency ecosystem, reading everything I could get my hands on. And I came to some very different conclusions from the ones that I had before. I began to realize that a lot of the concerns and objectives that I had, and the same concerns that I commonly hear from the mainstream financial community, were stemming from a superficial understanding of cryptocurrencies and how they worked. And once I dug a little bit deeper into how they operate, every one of those concerns was adequately addressed. And I realized that in some cases, some of the concerns being brought up were completely unfounded. And to be very clear, I put myself into this category because these are the same arguments I was making 1 year ago as to why I didn't think it was wise for clients to invest their money in Bitcoin.
Yeah, and I was in a similar position. But so about 1 year ago, was this when we had all of the advisors on our team begin to do our weekly study sessions?
Yes. So at that point, we'd already been getting a lot of questions from clients about Bitcoin. It became very clear to me that this was going to become a bigger and bigger part of our lives. And we were going to only run into this more and more from clients. And I also saw that many clients, not only were a lot of clients asking for advice about it, but most financial advisors seemed to completely ignore it. If I ever brought this up in a typical, financial services conference, brought it up to an economist, I mean, it sort of seemed to get brushed aside. And that's when I decided that we needed to get everyone on our team up to speed so that at a minimum, we could have some intelligent conversations about it internally. And so that every advisor is equipped to give sound advice to their clients. And it's around that time when I enrolled us in the DACFP, which is the Digital Assets Certification for Financial Professionals. And we started doing those weekly study sessions as a team.
Well, I will say I enjoyed the study sessions because I too wanted to learn about it, but I wanted to learn about it in a framework that made sense. I didn't want, to go out to YouTube and Google Bitcoin and see what I could learn that way. But learning it in a professional capacity was very good knowledge, and it was factual, which was great. So what were some of the other conclusions that you came to?
Well, I do believe that it's likely that Bitcoin will eventually be overtaken as the largest cryptocurrency by market cap, that it won't always be the biggest one. I also don't think Bitcoin or Ethereum are ever going away. And I want exposure to both of these in my portfolio. I also believe that both Bitcoin and Ethereum are very volatile, but they've also got the potential for significant upside appreciation. And I think that in 5 or 10 years, we're going to be using cryptocurrencies more than we do now, not less. So I want to get a small amount of broad exposure to a diversified basket of cryptocurrencies.
Is that when you thought we need to start seriously evaluating Bitcoin as an investment? And was there anything that surprised you?
Yeah, actually, I'm glad you brought that up, because that is the point where we started taking this a little bit more seriously as, is this something we would actually allocate to in a portfolio? And as I started learning more about digital assets, I also started noticing more and more institutional investors quietly disclosing that they had accumulated positions in Bitcoin and other cryptocurrencies. And I still don't think this is the consensus view, but it's clear that institutional investors are adding these to their portfolios. And so some examples, there are a lot of very, very prominent hedge fund managers. The earliest was Paul Tudor Jones, who wrote a paper about the great monetary inflation and came out and said he was taking a position in Bitcoin as a result of it. Stanley Druckenmiller is another very prominent hedge fund manager that disclosed he had a position in it. And even Ray Dalio, who runs Bridgewater Associates, which is the largest hedge fund in the world, he was very openly against crypto for a while. And even he's come around, and I haven't followed it recently, but there's been rumors that he's positioning Bridgewater to start a crypto fund. Then you saw endowments. So the Harvard endowment, the Yale endowment, Stanford, Dartmouth, MIT, all disclosed that they'd taken positions in Bitcoin or other cryptocurrencies in their endowments. You saw a lot of large corporate treasuries, such as Tesla and Square, which those are technology companies, so it wasn't that alarming. But even KPMG of Canada, which is one of the big 3 accounting firms, disclosed that they put Bitcoin and Ethereum on their books, on their balance sheet. And then you saw life insurance general accounts, which are very conservative. Mass Mutual disclosed that they had taken a position in Bitcoin. These are all very sophisticated investors. And then in addition to that, you've seen some governments take positions in either Bitcoin or other cryptos. So if everyone's not aware, the government of El Salvador was the first to make it legal tender. And more recently, we had the Central African Republic. And there are several other governments that hold it. So in summary, what's happening now with digital assets, I think, is analogous to the tech bubble in the 90s. A lot of it is overhyped. There is a lot of junk. There are a lot of scams, just like there were in the 90s with the tech bubble. I don't know if anyone remembers pets.com, but there's also some amazing investment opportunities. And the issue is right now is that most people can't tell the difference between the two.
So that puts our firm in a bit of a crossroads. We have to make some difficult decisions, and we had to decide if we were going to move forward. And can you talk about that?
Yeah, this is it did put us in a position where we had to make some difficult choices, because this is an asset that is very misunderstood. It's very volatile, and people have very strong opinions about it. And we looked at this and we said, no client is going to fire us in 5 years for not investing any of their money in Bitcoin. But if we invest even a small amount of clients' money in Bitcoin and it goes down 50%, we could get fired, even if it's the right decision and it makes clients a lot of money 1 to 2 years later. And so it was a difficult decision. It was, do we stick our neck out and do what we think is best for clients, or do we play it safe? And we ultimately decided that, hey, we're a fiduciary. We need to do what we think is in our clients' best interests. And if we genuinely believe this is a tremendous investment opportunity, we owe it to our clients to try to get them some exposure in a prudent, responsible manner. And we felt like if we don't, there's a lot of our clients that are going to go out and try to do it themselves and possibly get burned.
Right. Well, I think almost everybody, regardless of, if your, level of exposure, but almost everyone's heard of Bitcoin at this point, but very few people understand it. Can you speak about Bitcoin and why it was important? It was first in that space.
Oh, absolutely. And this was part of my learning about Bitcoin as well. But I think to properly understand Bitcoin, we need to have an understanding of monetary policy and its place in the current financial system. Otherwise, Bitcoin doesn't really make sense. So bear with me, but I'm going to start by framing the conversation with a short story about a central bank. And then once we have that framework, we'll talk about the characteristics of Bitcoin, and they'll make a little bit more sense. So in this story, there is a central bank that issues pieces of paper, and each piece of paper is redeemable for 1 ounce of gold. And the central bank says, okay, we're going to have a redemption window. It's going to be from 9 to 5 every day, and you can swap this piece of paper for 1 ounce of gold. And this is working for a while. And the central bank eventually comes back and says, hey, there's a 2-month renovation and we have to close the redemption window. But all the gold is still there in the central bank. For every 1 piece of paper, there's still 1 ounce of gold. But we're going to close redemptions for 2 months because we've got renovations, and we'll reopen after 2 months. And so after 2 months, the central bank officials come back and they say, the renovations are taking a lot longer than we thought. It's going to take 6 months more, and the central bank is still closed for redemptions. But since people are still using these pieces of paper with each other, it's important that they continue to buy and sell them for the value of 1 ounce of gold. We can't have these pieces of paper that have 1 ounce of gold written on them not trade for 1 ounce of gold, especially since there have been no redemptions for 2 months. So here's what we're going to do. Every day, central bank officials are going to go into the central bank, grab some of the gold, go into the trading markets, and buy and sell the pieces of paper for 1 ounce of gold, using the gold that they take out of the central bank, just to prove to everyone that the pieces of paper are still worth 1 ounce of gold, even though the redemption window is closed. So in other words, they're going to provide liquidity at the exchange rate stated on those pieces of paper. And every day, they're going to go back and get more gold if they need to, or they're going to buy more pieces of paper for 1 ounce of gold, just to make sure that the exchange rate of the pieces of paper that say 1 ounce of gold stay there, but no redemptions. The central bank is still under construction, but the gold is still there. The pieces of paper are still 1-to-1 backed by 1 ounce of gold. Okay, now it's 6 months later. The renovations are completed, and the central bank comes out and says, there's actually not 1-to-1 gold anymore. So we lent some of it out during construction, and we sold some of it, but we have assets. We sold it out for loans and bonds, and we have some gold, which is what we use to go out into the market every day and buy and sell these pieces of paper to make sure that they're always worth 1 ounce of gold per piece of paper. But we don't actually have 1 ounce of gold for every single piece of paper in the open market. So construction's done, but no more redemptions. There's no more redemption window. No one can come to the central bank and actually ask to redeem their piece of paper for 1 ounce of gold. But we'll keep doing the thing we're doing. We'll continue to take the gold that we do have, go into the market and buy and sell these pieces of paper for 1 ounce of gold. We have a commitment. We're a central bank. We're the largest market player in the entire economy. we will make sure that those pieces of paper trade at an exchange rate of 1 ounce of gold per piece of paper. The gold standard that everyone talks about today in 1972, when Nixon took the dollar off the gold standard, is this part of the story, where the US is in a position where they can't redeem dollars for the actual gold backing their dollars because there isn't one-to-one at Fort Knox. There isn't enough gold. But the government has the duty to maintain the exchange rate of the pieces of paper as best they can. So where does this story end? Well, in the final part, the central bank says, okay, look, it's really hard to keep these pieces of paper that say 1 ounce of gold pegged at an exchange rate of 1 ounce of gold when we actually hold very little gold. We sold most of the gold. We have a bunch of loans that are making money, but that's not gold. So what we're going to do is forget that 1 ounce of gold per piece of paper. We're no longer going to market make at that price and guarantee that. Instead, what we're going to do, we realize that in an industrialized economy, the most important thing is not that our pieces of paper are pegged to 1 ounce of gold. What we need to do is make sure that the people who are getting paid in these pieces of paper can go out and buy the things they need with them. So what are the most important things in an industrialized economy that people need? Food, rent, medical care, cars, electronics, things that keep your standard of living the same. So we're going to compile the prices of all these things against a piece of paper. And if the price of these things are going up, we're going to have to buy some of those pieces of paper back with the assets that we have, which is very little gold, but a bunch of other stuff. And if the economy is becoming more and more productive, so more food is being produced, more cars and all these things, and the prices of these things are going down, what we'll do is we'll print more pieces of paper to make sure the price stays the same. That's what happened after 1972. And so I wanted to tell this story to frame the conversation because this is actually the story of central banking's evolution. And it's critical to understand how Bitcoin came about.
Okay, well, the story makes centralized monetary policy easier to understand, but how does Bitcoin address some of those issues?
Okay, so this is where it gets interesting. So the characteristics of Bitcoin, one is that it is decentralized. So what that means is no one controls it. No country, no government can step in and make changes to it. It's run by computers all over the world. They run Bitcoin nodes. Each node has a copy of the ledger of transactions. And every time a Bitcoin exchanges hands, all of the nodes have to agree. So the more popular that Bitcoin becomes, the more decentralized it gets, the more difficult it is to make changes to the network because more nodes have to agree to any of those changes. So you can think of Bitcoin as a global currency that everyone has access to, but no one controls. No country, no government, no central bank. The next characteristic, which is important, is that it is not inflationary. So, that leads us to the question, well, what is inflation? How does inflation happen? Well, inflation is when the value of your money goes down over time. It loses its purchasing power. All fiat currencies are inflationary. What is a fiat currency? I mean, basically all currencies we use are considered fiat currencies. It means they're issued and controlled by a government. The reason they're inflationary is that there is an unlimited supply. At any point, a government can go out and issue more of it. We've seen the United States do it. In the US, while the dollar has experienced inflation relative to the rest of the world, it's experienced very little. But all governments can go out and issue more of their currency. And it makes sense. If you issue more of it, the value of it goes down and it loses purchasing power. So Bitcoin is not inflationary because it's limited to 21 million coins. Excuse me. So what that means is there will only ever be 21 million Bitcoin. That's written into the code. It's written into the algorithm. No government, and because no one can control it, no government can come in or no central bank can come in and say, we're going to make more Bitcoin. And so rationally, as adoption increases, you're going to have more, as more people start using it, there's the same number of Bitcoins to be spread out among them. This would naturally, you'd expect it to drive the price up over time. So if you're concerned about inflation as we are, this makes a lot of sense as a long-term holding.
So it's different from the inflationary perspective, but Bitcoin is very volatile. It has a lot of ups and downs. So who's actually using it?
So in the United States, I think it can be hard to understand why anyone needs this. We have a stable currency, the dollar. We have access to the banking system. And so people will say, I've got Venmo, I've got Zelle, I have PayPal. Why do I need Bitcoin? But the reality is that most of the world doesn't have access to these things. And in many parts of the world, people live in countries with very high inflation. So if you grow up in Venezuela, where I think in April of 2019, the International Monetary Fund estimated that inflation would reach 10 million%. That's when it peaked in Venezuela. So if you grow up in an economy like that, how do you save money? Because if you're wealthy, well, you'd go out and you'd buy real estate, because no matter how bad the currency does, the real estate holds its value. Or maybe you invest abroad. Maybe you go out and you buy US treasuries, which are paying next to nothing. You know, maybe they're paying less than 2%, but you don't care. It's a great deal if you're in Venezuela, because it's not losing value. But if you're poor, you get paid in the local currency, you save in the local currency, and you don't even have the ability to go out, work, and then save your money and know that it's going to be worth something in a month or in 2 months, and much less a year. And so in countries that have high inflation, there's no way to break that cycle of poverty. But with Bitcoin, all you need is a cell phone. The volatility of Bitcoin to somebody like that is not very important, because at least it will hold its value. So what we're seeing mainstream use of Bitcoin in countries facing major inflation, like Venezuela, like Turkey, like Argentina. And if you look at how it's being used at the moment, it's really being used more like a store of value than an actual currency. So people aren't using Bitcoin to buy coffee, but they are using it as a savings vehicle.
Okay. A lot of people have heard of Bitcoin, and thank you for giving us kind of more of a context for is decentralization and where it was started, and that it is limited. Another thing out there is Ethereum, though, which is also, you know, a big player in the cryptocurrency space. Can you talk about Ethereum and how it fits into that landscape?
Absolutely. So Ethereum is the second largest cryptocurrency by market cap. And you can think of Ethereum like programmable money. So it allows you to create programs that execute monetary transactions. And these programs can then be used by people all over the world to transact on the Ethereum network. These programs are called smart contracts. And so an example of a smart contract would be, well, let's use a real world contract. So Heather, let's say you and I are going to enter into a business arrangement, and I say, I'm going to, you know, build, I don't know, 10,000 widgets, and I'm going to sell them to you for $500,000. And I want you to go ahead and pay me half up front, and I'll get paid the other half when I deliver the widgets. Well, we'll sign a contract, and we both live in the US. So you're confident that if I don't hold up my end of the bargain, you can sue me or take me to court, and the regulatory authorities in the United States are going to hold me accountable, and you're going to be made whole. But what if I live in Nigeria and you live in the United States, and you want to buy those same widgets, and I manufacture those widgets? Well, you're probably not going to enter into that contract with me.
Yeah, I may not feel as confident about that.
No, because not only am I on the other side of the world, but you also don't know how the Nigerian legal system works. And maybe you're not comfortable that those same institutions would hold me accountable in Nigeria. So a smart contract solves that issue, because what we would do, for example, is if we were transacting in Ethereum or in Ether, is I might say, okay, I'm going to make these widgets. You're going to take the equivalent of $500,000 in Ether, and you're going to put it into an escrow account. And as I make these widgets, I'm going to use RFIDs to scan them all and load them into a shipping container. And then that shipping container is going to have a GPS tracker on it. And when that GPS unit on the shipping container crosses a certain meridian on its way to the United States, all that money that you put in escrow is going to be released to me. And if that doesn't happen within 60 days, it's going to be released back to you. And you don't have to rely on the Nigerian government to hold me accountable. And I don't have to rely on you to actually send the money. And that's the tip of the iceberg, but that's what smart contracts can do. And so once you create this smart contract, once it's created, anybody in the world can use it to transact. And so, there's thousands and thousands of applications like this that have been created on the Ethereum network to create exchanges for currencies, borrowing and lending protocols, digital marketplaces. So everything, a lot of things that the traditional banking system does now are being created on Ethereum, where you can do them without having the bank as an intermediary. So in short, Ethereum is much more powerful than Bitcoin. You can program it to do anything, but this has its own pros and cons. And one of the drawbacks is that it's less secure than Bitcoin.
What would make it less secure than Bitcoin?
Well, the Bitcoin blockchain is extremely simple. It has a very limited programming interface. And in blockchain design, a limited interface makes your software more secure. So there are fewer ways for malicious actors to even interact with it. Bitcoin was only ever intended to be money. It was designed to do one thing and to do it extremely well. Ethereum is designed to do just about anything. It's much more powerful, but this comes with trade-offs.
Okay. So I guess part of what you're saying is that the digital asset cryptocurrency space is not, that there's a lot of different currencies out there doing different things. They're not all the same, even though sometimes we tend to group them together in our mind as cryptocurrencies. They're very, very different, and they have pros and cons.
Well, and Heather, I think that's a really good point, is that there are reasons why there are so many different cryptocurrencies, because there are niches that different ones work in. And, so Bitcoin has its own niche, Ethereum has its own niche, and there are other ones that are coming about to kind of solve these problems.
All right. Well, my next niche, I guess, if you want to call it that, is about stable coins. They have been in the news as well, and it's a term, it's a different term in that space. Can you talk about stable coins?
Absolutely. So stable coins are cryptocurrencies that are pegged to a fiat currency such as the dollar. So again, a fiat currency is a currency issued by a government, like a dollar or a euro or a yen. Most stable coins are denominated in dollars. But so what we're really trying to do, you think about, I guess the question would be, why would you do that? Why would anyone want to turn a dollar into a cryptocurrency? And it's basically so that you can have fiat money transactions on cryptocurrency rails. So an example would be, let's say you want to enter into a smart contract transaction with someone, but you want to be paid in dollars, not in Ethereum. You would need a stable coin to do that. And to do this, you need to find a way to digitize dollars, for example, and then put them on the blockchain.
Okay, that makes sense. If we were using my example of me buying something from you in a smart contract, I would probably eventually want dollars. So I would use the smart contract. I would get a stable coin, and then it would all work out. Okay. Are there different types of stable coins, and or do they have different pros and cons and different levels of risk?
So this is a great question, because stablecoin is a broad term, and there are different types. So the first distinction you want to think about is there are centralized and there are decentralized stablecoins. So a centralized stablecoin means it's issued by a centralized agency, right? It could be a private company, it could be a government, in which case it would be something like a central bank backed digital currency. Decentralized means similar to Bitcoin, similar to Ethereum. It is a stable coin that nobody controls. The other distinction, which I think is really important, is you have asset-backed stablecoins and algorithmic stablecoins. So asset-backed stablecoins are ones where, let's say, for example, you're trying to create a digital dollar, and there's a handful of these. Tether, which is ticker USDT, and Circle's USD coin, which is USDC, are two of the most common. I mean, it's basically dollars on crypto rails, but they're asset backed. So for every USDT or digital dollar that Tether issues on the blockchain, they take a real dollar or dollar equivalent and they deposit it somewhere. And they make the claim that every USDT that you have is redeemable for a real US dollar. Same thing with Circle's USD coin. And that's why you see these asset-backed stable coins, they're under a lot of scrutiny for regulation because and you're seeing some regulation coming in this area because regulators want to make sure that they have those assets that they say they do. So asset-backed stable coins on the spectrum of risk, really lower risk. I mean, there are some risks associated with them, but you're they're in theory, every asset-backed stable coin is backed by an equivalent dollar. Now, algorithmic stable coins are very different. They are not necessarily backed by anything. They're programmatically designed to try to peg to the dollar. And that's typically done by matching it to a different cryptocurrency. And the algorithm might buy or sell it to keep the price stable to a dollar. So this has been in the news recently. Algorithmic stablecoins, it's debatable whether this will actually work. There's a lot of reasons why I think why people are constantly trying to create an algorithmic stablecoin, but as of yet, we haven't had any that have worked. There are several out there that are trying. The one that's been in the news recently is Terra Luna, which crashed and lost billions of dollars for people. But I want to be really clear, this is not something we're using. And this is a really important differentiation because you could have two stable coins that are trying to achieve the same result. They seem the same, but they're very, very different. One is relatively safe. The other is very risky. So most people don't know the difference. And because of this, when the risky stable coin eventually implodes, there's a misperception that all stable coins are risky and everything sort of gets painted with the same brush.
Okay. So it's important as we learn more about this, that we make distinctions between different types of things in this whole cryptocurrency landscape. Because the technology is very exciting, but it's not all the same. And we need to, that's part of our job, is to realize that some things may be good investment opportunities and some things we would definitely stay away from. So why do we think that this space is a good investment opportunity?
So the macro landscape or the global economy has pushed crypto prices down along with stocks, bonds, and everything else. So, we've all seen what the market's doing. There's a lot of fears that, as the Fed raises interest rates, we trigger a recession. So it's pushed crypto prices down along with everything else. The difference is that the fundamentals in a lot of cryptocurrencies, again, not all of them, because there's a lot of bad ones, but let's say the bigger ones, the ones that have been around, that have real world use cases, the fundamentals are very attractive and they just keep getting more and more attractive as adoption increases. And so a great analogy I heard recently is that crypto is sort of like a coiled spring. The fundamentals are providing upward pressure. They're very positive, while the global economy is providing downward pressure. Eventually that tension will get released. And we think that over time adoption will increase. In 5 years or 10 years, there's going to be more people using cryptocurrency, not less. And there's a lot of reasons for that. One is that it is going to become easier to use. Right now, to use a lot of these cryptocurrencies, you have to be a little tech savvy, let's just say. That is going to get easier and easier, just like the internet did. Again, if you remember the early days of the internet, in the early 90s, it was only sort of tech people that were using it. Now everybody uses it. I don't know anybody that doesn't, search Google when they need to find something or shop on Amazon or, and you don't really need to understand how websites work, how the back end works. You don't need to know HTML to do that. The same thing is going to happen with cryptocurrencies. They're going to be the back end for a lot of things, and they're going to get easier and adoption will increase. Another reason is that a younger generation is what we would call digitally native, right? They've grown up with a lot of these things. I'm older. I remember the analog world. I remember the world before the internet. I think younger generations, the idea of using a cryptocurrency is just going to, it's going to be more of like, well, of course, why would anyone not use a cryptocurrency? It has all these benefits. We're also seeing that Bitcoin at this point, not that everyone uses it, but it's pretty mainstream. Most people have heard of it. Most people know what it is. 5 years ago, I think if someone approached you about Bitcoin, you'd kind of go, oh, that's a crazy idea. Today, I think a lot of people still think it's crazy, but a lot more people don't. And again, I would really equate this to the internet in the 90s, where at the time there was a lot of skepticism. There were people in the 90s saying, nobody's ever going to shop online. No one's going to be comfortable putting their credit card information in and buying things from, not going to the physical store to see it. And we've seen that that's obviously not how things have played out. We believe that just like the internet, this is going to change our lives in ways we can't really fathom yet. So again, think about where you were in the 90s when the internet was just starting and how you would have felt if somebody tried to explain Uber to you. If they said, well, yeah, in 15 years using the internet, we're all going to have strangers drive us around and we're not going to take taxis as much. Or if someone had tried to describe Airbnb to you and they say, well, yeah, in 15 or 20 years, we're going to use the internet. And when we travel, we're not going to stay in a hotel. We're going to stay in a stranger's house. Or Spotify, if they said, well, in 20 years, you're not going to buy music anymore. You're just going to rent it and you're going to have access to all the music in the world, but you're not going to own it. You're not going to buy CDs. So that would have been unfathomable 20 years ago because the internet hadn't gotten there yet. But as it develops, we see a lot of that same thing happening with cryptocurrencies. And here's the other thing that is really exciting. And this is just as an investment opportunity, but it's the idea of a Bitcoin ETF. So we already talked about the fact that there's only 21 million Bitcoin. There is a finite supply. There's more than 10 applications on the SEC's desk for a Bitcoin ETF. None of them have been approved. And the reason has more to do with regulatory clarity and what government agency would be in charge of it. Now, the SEC has approved Bitcoin ETFs that use futures. So in other words, they're not buying real Bitcoin, but they're buying Bitcoin futures. So they've approved that, but they haven't approved any Bitcoin ETFs that actually go out and buy Bitcoin. Why is that? Well, a futures ETF is a far inferior product. It's more costly. It gets front run. But they've approved that, and they've approved that because that has regulatory clarity. We know which agency is overseeing futures. And so in a lot of ways, that's the thin end of the wedge. It tells us that investors want this. There's a demand. The SEC has approved a product that is inferior for investors. It's a matter of time before they approve a real Bitcoin ETF that goes out and buys Bitcoin. And when that happens, what do you think is going to happen to the price of Bitcoin? Because suddenly we're going to have all these institutional assets buying Bitcoin to build these Bitcoin ETFs, which there is a demand for. Well, there's a finite number of Bitcoin. There's going to be a lot more buyers at that point, and that's going to drive the price up. We believe the same thing, probably not as close, will eventually happen with Ethereum. It's the second largest cryptocurrency. There are already Bitcoin ETFs in Canada and Ethereum ETFs in Canada and several other countries. So when that happens in the United States, there's going to be a lot of buy pressure that will likely drive the price up. So there's a lot of reasons to really be optimistic about this as an investment.
Well, I like the image of the spring, the coiled spring, that there's economic pressures, kind of pushing down, but that there's all these fundamentals that, that we think can help it in the long run. And even on a more specific scale, the Bitcoin ETF would be like that. Like there would be, this springing of opportunity when you can buy it in that form. Well, a lot of times we get questioned about risks in investments. We know that all investments, even putting money under your mattress has a risk of some type. But let's talk specifically about this particular market and the real and perceived risks of digital assets.
Absolutely. And so I think you bring up a really important point, which is what are the real risks and what are the perceived risks? Because there are both.
Mhm.
Investing in Bitcoin or Ethereum or any other digital asset does have real risks associated with it, but it also has a lot of what I would call perceived risks, where if you dig a little deeper, that's not a risk that you actually face. It's just misunderstood. So
Mhm.
one of the real risks is volatility. These are very, very volatile assets. We believe that they have a lot of potential upside appreciation, but in the short term, I would not be surprised if one of these assets is down 50% in a day.
We've seen some real volatility really
Very
recently
recently,
too.
yes,
Yeah.
which I think we definitely need to touch on. So volatility is a real risk, but it's also a tremendous opportunity, because if we can include this in a client portfolio, if we genuinely believe that there is tremendous upside appreciation, but a lot of volatility, we can employ the same strategies we use with the rest of your investments. We can rebalance. If it goes down and we want to have a certain percentage in your portfolio, we buy more of it. If it goes up 50% or 100%, we trim it down and we sell it. And over time, it's not that we know in the short term whether this is going to go up or down. It's that by having that disciplined rebalancing strategy, we're buying low and selling high on an ongoing basis. So volatility is a real risk, but it's also an opportunity. And along with that, I'd say another risk is just a lack of understanding and having the wrong expectations, because it is so volatile. This happens, we talk about this a lot with our clients. This happens with normal investments all the time, where people tend to buy at the top and sell at the bottom. It's the one industry where if you increase the price, everyone wants to buy more. And if you decrease the price, nobody wants it and they want to sell. And that's for emotional reasons. Digital assets are that, squared, because they're that much more volatile. And so it is very important to have an understanding of how this is going to behave and set the right expectations. Another risk is technical proficiency. Right now, if you're going to go out and buy Bitcoin or buy Ethereum on your own, you need to go open an account at Coinbase or Kraken or one of the exchanges, transfer money in. And there are some risks to doing that on your own. You could lose your private keys. And if they're lost, nobody can get access to those funds anymore. Not Coinbase, not you, not me, no one. So that's a risk if you just mess up and you lose your private keys. If you think about that, that's actually another reason in some ways to be optimistic about Bitcoin, because we say there's 21 million Bitcoin, or that's all that there will ever be. There's actually fewer than that, because people lose their keys all the time. And those Bitcoin will never be able to be accessed again. So in some ways, the supply is actually going down. Another risk is getting hacked. If you don't know someone hacks into your computer and your private key's on there, they could get your private key and transfer your funds out, and there's no getting them back. I think another risk that falls under technical proficiency is just scams. Like any new technology, cryptocurrencies are rife with people trying to scam you, because they know that most people aren't technically proficient. They're trying to figure out what they're doing. And you see it all the time. I mean, it's really insidious. You'll even see things like Google ads that are scams. Like you type in cryptocurrency and there'll be a Google ad that's a scam, that's trying to scam you. So those are all real risks to going out and doing it on your own. I think another subset of risks is government regulation. And again, some of these are real, some of these are perceived. One of the risks that people bring up all the time is, well, if it gets big enough, the government's just going to shut it down. That's not, there may have been a time very early in Bitcoin when they could have done that. But at this point, it's not possible. The US government could try to ban Bitcoin tomorrow. To effectively do it, they would have to turn off the whole internet for the whole world. China has banned Bitcoin. It hasn't done anything to the Bitcoin network. And in fact, they're at great risk of, but you can see that there are plenty of wallet addresses in China that citizens are still using it. So What governments can do is make it very difficult for their own citizens to access it. They can try to regulate it away and make it onerous, but they can't really ban it. And I'd say government regulation is a risk because, again, if there's a regulatory regime that is not favorable to it, that's gonna slow adoption. But I think the cat's out of the bag at this point. Some of the things that could happen kind of on the regulatory front is it could be treated as a security and taxed as a security. I mean, right now, the truth is we don't have a lot of regulatory clarity in the United States. Other countries have done a better job of this, but that is coming. And this is one of my to-dos, but very recently there was a bill passed or proposed in the House to really try to address some of these issues around cryptocurrencies. And what's interesting is it's a bipartisan bill. It's both Democrats and Republicans that proposed it. They're probably in the minority because they're the ones who actually understand cryptocurrencies. But in a way, it is really reassuring to see something bipartisan being proposed for once.
I agree with that, and I do think there's some pressure on the government to have clarity in that space. So in a way, it's a risk because it's not, well, for example, if there's applications for a Bitcoin ETF sitting there that haven't been acted upon, that's a little bit of an uncertainty still. So how would we go about taking out the risk of private keys, for example? How would we go about getting client exposure and minimizing some of those risks?
So we thought long and hard about this, do we even do this given some of those risks? And we feel like we can do it in a way that really minimizes the downside exposure for clients, but gives them access to something we think is an important part of the portfolio. So for starters, we only put a very, very small amount of client portfolios in this. And the rationale here is we want a small position to limit the downside risk. But we feel like even a very small position over time can meaningfully impact returns. And I think another consideration for us is we need a vehicle that we can rebalance into and out of along with your other investments so that we can take advantage of that volatility. So even if I could do this, I don't want to go out and open up a Coinbase account for everybody and buy cryptocurrency over there, because if it goes up and I want to sell some of that and buy some of your other investments, or if it goes down and I want to sell some of your other investments and buy more Bitcoin, it's very difficult to do if it's held in two places. So that was a real consideration is, can we do this, find a way to do this within client portfolios? Because another factor is if you've got all your money in your IRA, you can't open up a Coinbase account with your IRA. So is there a way to do that? Another consideration for us is we want something where we want a vehicle where we are getting institutional custody and insurance. I don't want to be the one managing everybody's private keys, and I don't want my clients to have to be managing their own private keys with a portion of their portfolio. So we definitely want a vehicle where it's institutionally managed. They've got institutional level security, processes, practices, and insurance. So what we ultimately came up with, for starters, we began with 1% of client portfolios. There is no other investment we have in client portfolios that is that small. Most of the time we'd say it's probably not worth adding at 1%. But we felt like it's meaningful enough because of the upside potential. But it's also small enough that, not that we think this would happen, but if it went to zero, if 1% of your portfolio went to zero, it would not have a meaningful impact on your returns. No one would not be able to retire because of it. So being as volatile as it is, it was very important to us that clients got comfortable with it first. So we began with a 1% allocation. We've increased it to a 2% allocation to take advantage of the recent crash, because prices have fallen. They're correlated to equities, and right now they're very, very attractive. We've got no short-term, I guess, we're not planning on increasing that anytime soon. 2%. We don't think that that's a super aggressive allocation, but we want to make sure clients are comfortable with it. So that's the first part. Very, very small amount of client portfolios because we want to manage risk and we want to manage people's expectations. So the next piece is, well, how did we get access to them? Because there isn't a real Bitcoin ETF. We didn't want to buy the futures product because once you investigate it, it gets you access, but it's not a great product. And what we ultimately chose are 3 investment vehicles: the Bitwise Crypto 10, the Grayscale Bitcoin Trust, and the Grayscale Ethereum Trust. These are private trusts that trade on the secondary market. And so they work similar to a closed-end mutual fund in that they trade in real time, their price moves up and down, and it correlates to the price of the underlying assets, but they can trade at a premium or at a discount. In other words, the Grayscale Bitcoin Trust only owns Bitcoin. Based on the price of Bitcoin, it should be X, but it could be trading above X or below X just based on how many people are buying and selling it. That could be a feature or it could be a bug. At the moment, it's a real benefit, we feel, because all of these are trading at a discount. So that means in addition to the fact that we believe this has a lot of appreciation, we're also buying shares in a trust where the underlying assets in the trust are worth more than what we're paying for the shares. So we feel like it gives us an additional cushion. And what would happen here? So like if we differentiate between the 3, so we've got the Bitwise Crypto 10, which buys the 10 largest cryptocurrencies by market cap. So that's primarily Bitcoin and Ethereum. It's about 60% of the market cap is Bitcoin, about 30% is Ethereum, and the other 10% is a variety of other Ethereum-like cryptos. But they also screen out things like meme coins, things like the Dogecoin or Shiba Inu. They screen out stable coins. So the Bitwise Crypto 10 had no exposure to Terra Luna. But we like it because it gives us a very broad exposure even to some of these up and coming cryptocurrencies that are, by market cap are small, but as adoption increases, some of these could be big winners. The reason we've chosen to divide it like this and then also have direct exposure to the Grayscale Bitcoin Trust and the Grayscale Ethereum Trust is that there's another opportunity here, and that is the arbitrage between the discount that these are trading for and the net asset value of the underlying asset. And so, for example, the Grayscale Bitcoin Trust trades right now at roughly a 10 to 15% discount to the underlying value of the Bitcoin. And so when a Bitcoin ETF eventually gets approved, and that might happen in a year, it might happen in 5 years, but we believe this is going to happen. When that gets approved, that discount is going to disappear because shares will either be created or redeemed, and will benefit from that appreciation as well. And so we've done the same thing for Bitcoin and for Ethereum, because that gives us another sort of shorter term potential for price appreciation if a Bitcoin ETF gets approved. So that's really how we've chosen to get client exposure. And there's a lot of thought went into that.
Can definitely tell a lot of thought went into both the amount of exposure and then the vehicles that we have chosen to actually get the exposure. So, and that there is a little bit of, based on those vehicles, there's a little bit of a cushion in the way that they're structured, which is also great for clients in that space. So, as we've been talking to people, throughout the last few months, what are some of concerns that we hear about moving this direction and getting investment exposure to cryptocurrencies? Let's talk about some of those concerns.
Sure. So we've talked about a couple of them. I think regulation is one. I think we covered that adequately. Another concern is that the government will ban it. I think we addressed that. That's just not possible. They can make it difficult to obtain cryptocurrencies or Bitcoin, but they can't make it go away at this point. I guess one concern I hear a lot is what is backing it? All this makes sense, but there's nothing backing Bitcoin. I don't feel comfortable because there's nothing backing it. And the question I would ask is, what's backing the dollar? no one's uncomfortable with their savings account that holds dollars in the bank, but gold isn't backing the dollar, at least not anymore, not really since 1972. And even prior to that, there wasn't really enough gold to back it. You could say, well, yeah, but the US military is backing the dollar, and there's some truth to that. But the US military alone and the government cannot prop up the value of the dollar indefinitely. That is particularly if monetary policy is not responsible. And I'm not saying that it's not, but as an example, the Venezuelan military is backing the bolivar, but it's worthless. The Turkish military is backing the lira, but as Bob can attest to, if Erdogan keeps lowering interest rates, the lira hasn't been in a death spiral. And the same thing in Argentina. The Argentine military backs the peso, but that hasn't kept its value. And so if you really look at that question, what's backing the dollar, there's nothing physical backing the dollar either.
Yeah.
Another concern is the perception of illicit activity, that like, hey, isn't Bitcoin, isn't it really used by criminals for cyber attacks and so forth? And this is an area where the facts don't really line up with the narrative. There is definitely that perception that has to do with the Silk Road, which if anyone's familiar with, this was a very famous case. It was a website on the dark web where people could buy drugs and all kinds of illicit items and services, and they paid by Bitcoin. This was very early days of Bitcoin. I want to say it was 10 years ago. Ross Ulbricht, the guy who started the Silk Road, is in jail. But that's kind of led to this perception as, well, Bitcoin's only used by criminals. The truth is it's not that way. There are far more dollars used for illicit activities than Bitcoin. Definitely in dollar terms, and even in percentage terms, if you look at percentage as a percentage of that asset, far more dollars are used for illicit activity. And frankly, Bitcoin and cryptocurrencies are a terrible vehicle for illicit activity because people think they're anonymous. They're really not. They're pseudonymous. In other words, you can track the wallet addresses and where those currencies are paid. So what people are slowly becoming aware of is that Bitcoin has actually been used to solve a lot of these crimes. That's why you'll see these ransoms occur, these large cyber attacks. They pay in Bitcoin, and then you find out that a week or two later, they got some of that money back. It's because those attackers got the Bitcoin, but they have no way to turn it back into currency they can spend without getting caught. And so then they'll come back and say, oh, we're actually a white hat hacker, and we found this code, and we're just trying to, help you. And here, we're going to give your money back, and why don't you just pay us a bounty, right? So all of the—
Can I interject? We have a question related to that.
Sure.
Jose is asking, what about the use of cryptocurrency for clandestine transactions, and would it promote using international black markets?
Again, I think that's a misperception. So let's kind of talk about how that would occur, and some of this gets pretty technical, but there's plenty of companies that do this, but one really famous one is it Chainalysis, right? Which they're not very well loved in the crypto industry, because what they do is they analyze the blockchain and they help track transactions all over, and they work for the US government. Right? If the US government wants to find someone, Chainalysis is one of those companies that will essentially track the funds back. And eventually there's a choke point, and that choke point is going to be on an exchange where you're trying to take that Bitcoin or Ethereum and trade it for dollars or euros or yen or something that you can actually spend in the real world. Because right now there are a lot of things you can buy with Bitcoin, but you can't do everything with it. There are ways to try to obscure it. There's what are called mixers, where it tries to kind of break that trail. But again, the services that do that are typically subject to some kind of regulatory authority. And as an example, let's say that I blackmail you for Bitcoin, and I have you deposited into my Coinbase account. Well, the government tracks that, and then they go to Coinbase and they say, you need to shut this account down right now. And so I guess what I would say is it's a lot harder than it sounds. Now, there are certain cryptocurrencies that are purposely designed to obscure that. Monero and Zcash are two, and there's very legitimate reasons why maybe those should exist, but there's pros and cons to those as well. So this is really an interesting topic, and we could probably spend 30 minutes or 45 minutes talking about it specifically. But the use of these currencies for illicit activity and even to evade sanctions is actually very difficult, because one of the things that makes the blockchain is that it's publicly available for everyone to see. So it's not like a bank transaction where I can wire someone $1 million and only I know and the person receiving it knows. If this happens on the blockchain, it is a public ledger and anybody can see it. And so you have people all over the world that follow these transactions anytime something fishy is going on.
What about tax treatments? Another concern we hear.
Yeah, I mean, I definitely think that is a concern, and that's a legitimate one, because we don't have regulatory clarity over it, and we don't exactly know how it's going to be treated. And I would argue that right now in the US, the tax treatment doesn't make a lot of sense. But again, there's a proposal right now to address some of those issues. And what we're really seeing is that most governments, most liberal democratic governments are realizing that this is a technology that they're going to need to embrace, because their citizens are going to use it whether they like it or not, and they can't stop it. You're seeing the opposite happen in authoritarian regimes like China, where they're trying to ban it. They're trying to make it really hard, because in a lot of ways, this is a force for freedom, and it allows their citizens to do things that maybe for example, in China, they're trying to they've created their own central bank digital currency, and they're trying to really promote that. And so that's part of the reason they banned Bitcoin, because they want people using the digital yuan, which they can track and they can control, and they can see what you're spending money on. So I'd say tax treatment is a concern, but it's something that is being resolved.
It's another one of those areas that we don't have complete clarity yet in that space. We are coming up on time, but I just wanted you to briefly speak about one of the other concerns that we hear, which is the environmental impact of particularly Bitcoin mining. We hear a little bit about that. So can you speak briefly to that as well?
Yeah, absolutely. And just because we are short on time, I mean, the environmental, social, and governance issues, we could spend an hour talking about just them. It's actually really fascinating, but I'm going to try to go through them pretty quickly. And then I do want to leave, even though we're over, we will stay a little longer if anyone has questions that they want to address. So let's start out with the E, which stands for environmental. Like every other industry, cryptocurrencies are in the process of moving from a carbon-intensive past to a more carbon-neutral future. So to really understand this, we have to talk about the consensus mechanism that's used for Bitcoin, and that's proof of work. Both Bitcoin and Ethereum use proof of work as a consensus mechanism at the moment. This is the way that all of the computers on the network talk to each other and come to agreement on what transactions happened. And proof of work relies on computers on the network solving very complex mathematical problems. And this is very energy intensive, but it's also very secure. There is another consensus mechanism called proof of stake. This is a consensus mechanism where instead of solving these complex problems, each of the nodes has to put up their assets into an escrow account. And if they do anything nefarious, those assets are taken away from them. So they can be punished. Now, for proof of stake, the energy consumption is negligible. They're not solving all these complex problems. Many newer cryptocurrencies are already using proof of stake, and Ethereum, which is the second largest cryptocurrency, is transitioning to proof of stake likely by the end of the summer. Okay. After this happens, the second largest cryptocurrency's energy consumption is going to be de minimis. So with that in mind, it's possible that Bitcoin never makes that transition to proof of stake. There are many reasons why they might want to keep proof of work. It's more secure, it's been tested, it's been around longer, it's proven. However, Bitcoin miners have been very aggressively moving to green energy to power the Bitcoin network. And there are a lot of economic incentives for them to do this. So in other words, it's still energy intensive, but hey, can the energy that they use to mine Bitcoin be more green? And in fact, Bitcoin mining already has the highest renewable energy mix of any industry in the United States. And again, we can get into the specifics, but there are a lot of economic incentives for Bitcoin mining to happen around renewable energy sources. And I don't just mean government incentives, I mean strict economic incentives, why that energy is just cheaper and it makes economic sense for them to use it. So that's the E portion. The S, which stands for social, this is where I think cryptocurrencies really shine. And I think you can make a very compelling case that Bitcoin itself is an ESG investment and that it should be included in all ESG portfolios, because you cannot overstate the impact that Bitcoin and other cryptocurrencies are having on poor, unbanked populations around the world, that they're having on people who, for example, live in under an oppressive government regime. I've sent this to a couple of clients, but there is a great interview that I listened to with Alex Gladstein, who is the Chief Strategy Officer at the Human Rights Foundation, where he talks about the impact that Bitcoin is having on people who live in authoritarian regimes. And it's really eye-opening at just from a social standpoint, the impact that this is having on the very poor. And then the last, the G, the governance, this one kind of speaks for itself. I mean, part of what made Bitcoin so innovative, and as a result, some of these other cryptocurrencies, is the governance model, is that it created a way for a governance model where no one's really in charge. And the governance model really forces the best interest of the network and of all the users of the network. So I think you can make a really strong case that this should be in ESG portfolios because it's having a lot of positive impacts, particularly on a social level.
That is it's a merger of interesting topics that maybe we can explore even more in depth in the future. I think this has been very informative. A part of our objective today was to answer some questions like, what is Bitcoin? What are digital assets? What does all of that mean? And we hope we've given you some insight into that today. We hope we've answered some questions of why we would, we have become more interested in this and what we've learned in our own personal journey. How it is done in portfolios now with a limited exposure and the vehicles that we've chosen to have it represented in portfolios. So we wanted to answer some of those kind of key questions today and just sort of expand the conversation about this really new and growing space. So thank you for your time today. We are happy to do some questions, but I understand if if the time that you blocked for this is over. And we really appreciate you attending, and we hope you had a little snack from us along the way. Thank you very much. I do have a question, but anybody who feels like they need to drop off, thank you so much for your time today. The question I have is related to the news over the weekend about Celsius and their lending platform, and they paused it. And I think this really brings up some of the other points that we've talked about today, that there's a large spectrum of things out there. And even when we have investor exposure, it is not to every type of thing. But Jamie, do you want to speak a little bit about that?
Yeah, absolutely. So that made news, particularly with the downward pressure on prices. And this is very similar to what happens in the stock market, where more aggressive traders or investors are leveraged and prices go down and they get a margin call. And then they're in this death spiral where they've got to sell assets to pay their margin, to cover their margin, right? In the cryptocurrency space, that can also happen where people are leveraged. They can actually use a lot more leverage. And as prices have gone down, you're going to see a lot of the fluff getting shaken out of the marketplace. And so we've seen a couple things recently that have driven prices down. One was the Terra Luna debacle, which was really devastating for a lot of people that had money tied up in it. I mean, billions of dollars lost. More recently, we've had Celsius, which I'll talk about, but and it's very possible we'll see some more, because there are investors that are very highly leveraged and have taken on way too much risk. So that said, what happened at Celsius? Some of this gets kind of technical, but what Celsius is doing, so we talked about Ethereum moving from proof of work to proof of stake. It's an event called the Merge, which is likely going to happen, I mean, in August. It's gotten pushed back several times, but when they move to proof of stake, Ethereum is actually going to start paying interest or a dividend for staking your Ethereum. In other words, you're putting up your Ethereum as collateral for these nodes, and a portion of the fees get paid to you. So Ethereum is already operating simultaneously on a proof of stake network. So it's been a very gradual transition. So you actually can stake your Ethereum right now, but it hasn't fully transitioned to proof of stake. So what that means is, if you stake your Ethereum right now, it generates a yield. I think it's paying 5 or 6% in ETH, but it's illiquid until after the merge happens. You can't get it out. Now, again, the merge, it's been anticipated for a long time. You know, they've been saying, oh, this is 6 months out, and then 6 months go by, and then we're not ready. It's 6 months out. All signs are pointing to it happening very, very soon. But if you stake your Ethereum, it's illiquid. So what does Celsius do? So they're a platform that allows people to stake their Ethereum. There is, and again, this gets really technical. There are platforms out there that allow you to stake your ETH, and they give you kind of like a voucher for your staked ETH, and you can trade that voucher, and you can lend against it, and you can do all these financial transactions on it. But there's a discrepancy between the value of that voucher that is redeemable for ETH eventually and the value of ETH. And that's what Celsius was kind of playing in, is that they were saying, hey, stake your ETH with us, but we'll make it, but you can redeem it at any point. Meanwhile, they're having to stake it, and they can't redeem all of it. And that's what's happened essentially, is it's a combination of factors, is that prices have gone down. They also lost some money in the Terra Luna debacle. And there is some question of if they have all of the assets that people have deposited there. So, you know, I don't know what the numbers are. They definitely have real assets, but it might not be 100% to cover all the people that put assets there. And then the other issue is that they've had to freeze withdrawals because they don't have enough ETH. Even if it's staked and it's all there, they don't have enough ETH to let everybody withdraw it. The same way that a bank, if there was a run on the bank doesn't really have enough money if everybody simultaneously went to pull all their money out of their checking and savings account. So it's a similar situation. They were too aggressive. There are, again, in the crypto space and in the DeFi space, it's very important to understand what are the real risks, because there are versions of Celsius that are much more conservative, and Celsius was not. They were paying very high yields, and they were doing it for a reason. So all of that said, one of the things that is encouraging is that there are other players in the crypto space that maybe run more conservative versions of that business. One of them is Nexo.io, and they're already making offers to buy Celsius's assets out of bankruptcy.
Okay. Well, thanks for that. I guess just to be clear, in our investments, we are not in the lending space in cryptocurrencies. Just from a client perspective, we're not doing that. But thanks for clarifying that. We have another question kind of related to currency usage and assets versus currency usage. Do businesses accept crypto as payment, and can you get dollars back if you spend that way?
This is a great question. It's really fascinating. So the short answer is yes. There are plenty of businesses that accept crypto, but it's not all of them do. But one of the things we're seeing is, so I think Square and PayPal have integrated, and so has Cash App, if anyone uses Cash App. They have natively integrated several cryptocurrencies into their apps. So what that means is you can pay someone using Square or using PayPal in crypto. Even if the merchant doesn't accept Bitcoin, you can pay them in Bitcoin. And what's happening behind the scenes is Square is converting that Bitcoin to dollars and giving it to the merchant. And the same thing is happening on Cash App and several other apps. So that alone really makes it very viable to actually transact in crypto. That said, that's not how Bitcoin is really being used in the United States. You could transact in it, but it's really being used more like a store of value than a medium of exchange. And that has a lot to do with the volatility. But what we expect is that over a long enough period of time, and this might be 5 years, 10 years, 20 years, as adoption increases, and the price goes up, the volatility is going to go down until eventually it does actually perform like a currency. It might be a long time before that happens, but that's what we would anticipate.
Okay. Thanks for that. I know I've seen a sign for a Bitcoin ATM in my area. But I still feel like in most of our views, it's definitely more of a store of value than a currency that we're going to use on an everyday basis.
Yeah, and just to speak to that a little bit, Bitcoin ATMs, you'll see those. I don't know that I would use those. I mean, I think what they do is you can take dollars, physical dollars, and put them in like a reverse ATM and they issue you Bitcoin. There are cheaper ways to do that. If you want to do that, you're probably better off opening an account with a cryptocurrency exchange and just electronically transferring dollars in.
Yes, I kind of agree. Since we're talking about digital currency, a physical ATM seems a little out of scope and not quite necessary. But well, thank you everyone for your time today. Thank you for tuning in and kind of going on this journey with us. And have a great afternoon. Jamie, thank you for your expertise and sharing your time as well. And everybody have a great day.
Have a wonderful day, everybody. Thank you.